Welcome. In the complex world of finance, where numbers tell stories and every transaction holds a risk, there is one standard that pulls back the curtain on a company's financial soul. It's the standard that forces transparency, demands clarity, and reveals the true exposure of a business. This is IFRS 7, Financial Instruments, Disclosures. At its core, IFRS 7 has two powerful objectives. The first is to help users of financial statements, that's you, me, and investors everywhere understand the significance of financial instruments to an entity's financial position and performance. This goes beyond just listing numbers, it's about explaining what those numbers really mean. The second, and perhaps most crucial, objective is to enable users to evaluate the nature and extent of risks arising from those financial instruments. Think of a financial report as a health checkup. IFRS 7 is the part that reveals a company's vulnerabilities, its stress points, and its resilience in the face of market volatility. To meet its first objective, IFRS 7 requires detailed disclosures that paint a complete picture of an entity's financial instruments. On the statement of financial position, an entity must disclose the carrying amounts for each major category of financial instrument. This includes financial assets measured at fair value, amortized cost, or fair value through other comprehensive income. It's like a financial instrument census, showing us exactly what's on the books. On the statement of comprehensive income, the standard demands a breakdown of interest income and expense, as well as net gains and losses from each category of financial instrument. This allows us to see how a company's financial instruments are directly impacting its profitability. This is where IFRS 7 truly earns its stripes. It requires a company to tell a story about the risks it faces. The first face of risk is credit risk. This is the risk that one party to a financial instrument will cause a financial loss for the other party by failing to discharge an obligation. To be transparent, a company must disclose its maximum exposure to credit risk without considering collateral. It must also provide information about any collateral it holds as security. This tells us what a company stands to lose if a debtor defaults, and what protection it has in place. Next, we have liquidity risk. This is the risk that an entity will encounter difficulty in meeting obligations associated with its financial liabilities. In other words, can the company pay its bills when they come due? IFRS 7 requires a maturity analysis of financial liabilities. This is a powerful disclosure that shows when a company's financial obligations are due. It's a roadmap of future cash outflows, allowing users to assess the entity's ability to manage its short-term and long-term debt. Finally, we confront market risk. This is the risk that the fair value or future cash flows of a financial instrument will fluctuate due to changes in market prices. This is further broken down into three types: currency risk, interest rate risk, and other price risk. To illustrate its exposure, a company must perform a sensitivity analysis. This disclosure shows how a reasonable, possible change in a market variable, like a shift in interest rates or a foreign exchange rate swing, would impact the company's profit or loss and its equity. It's a stress test that reveals how resilient a company is to market shocks. IFRS 7 is not just a list of rules, it's a commitment to transparency. It empowers financial statement users to move beyond the surface-level numbers and truly understand a company's financial health and its risk profile. By providing this detailed information, companies build trust and allow for better informed decisions. It is the language of risk, spoken fluently for all to hear. If you found this explanation helpful, don't forget to like this video, share it with your network, and subscribe for more in-depth looks at the world of finance and accounting. Thanks for watching.